Hey, good morning once again, options traders, and welcome back, everyone. And I just wanted to point out a really important topic for all of our traders in the group, and that is about predicting when the stock market bubble bursts. Now, it turns out I could have produced this video in the last probably 2 or 3 years, 4 years. People have been talking about that the market is at all-time highs. And that might be true, but it's an entirely different thing to say that that means we're about to turn. And so there's really two main predictions that are going on here, and you need to be aware of that, because otherwise it's very easy to get lured into this sell everything and get back in when the market falls. So what are the two different predictions that are going on, and why do you have to be so careful? So first, when we're talking about stock market highs, yes, traders talk about the market being at all-time highs all the time. That's nothing new. But the problem is that they believe this means it's more likely to fall. And this is the false claim, or at least the one that you have to be the most careful of. Now, when you are at an all-time high, that's a fact. Yes, agreed, we are at an all-time high. It doesn't take a stock market genius to say we are at stock market highs. But the thing that they're missing is that highs can go higher, a lot higher, and for a long time. So predicting when the bubble will burst is an entirely different prediction. So to see a good demonstration, let's head over to an Excel spreadsheet. Okay, so now we're into an Excel spreadsheet, and I've done similar demonstrations like this before with a coin toss. And in this particular worksheet, we have 5,000 flips of a coin. So that's this first column, just goes all the way down 5,000 rows. The second column, I'm having Excel flip a coin. It's just coming up with a random number between 0 and 1. And if it comes up with a 1, we're going to call that heads, and we'll say that you're going to win $1. And if it comes up tails or a 0, you're going to lose $1. And so this column tells you the gain or loss on that flip. So in this first row, we flipped a head, we gained $1. Second row, we flipped another head, we gain $1. Third row, we flipped a tails, we lose $1, and so on all the way down. So this next row, labeled the net, is just showing you your cumulative gains or losses. So in this example, you flipped a head on the first one, we got $1, head on the second one, we got $1, so we would be up $2. Then we lost $1, so on a net basis, we're up $1. We lost another $1, we're back to even. Lost $1, -1. And it just keeps going on down the list. And so what you're looking at in this graph, this blue line, is this net. It's right there, all of those numbers. And so it's a random walk, a little bit like a stock market. Now it turns out that for this, the standard deviation would be about 35, and so 2 standard deviations would be 70. So this green line is plus 70, 2 standard deviations up, and the red line is minus 70, or 2 standard deviations down. So let's hit F9 and watch what happens to our chart. Just take a look at it. As expected, in most of the cases, we would think that it should be between those 2 lines, within 2 standard deviations. But you can see that it's not really all that uncommon to get outside of that, whether to the upside or the downside. So let's just find a good example here, like this. So yes, let's say back on this date, if this is the stock market here in blue, on this date, sure, you could make the claim we're at highs. We are 2 standard deviations up, maybe from where we were, or from what we would expect it to be. But that doesn't mean that we're about to turn. That's the fallacy. Notice that just because you're at all-time highs, highs can go higher. They can go a lot higher. And in fact, in this case, even when they did turn, doesn't necessarily mean you're going to be worse off. You're still right back to where you were. So another problem, and side problem, is that if you do get out here, and then the stock market goes up 20% and then pulls back 10%, and then everybody says, see, there's the big 10% correction we were talking about. Well, you still missed a good part of the run. See, if you got out back in here, and the stock market runs up to here, and then it pulls back down here, and everybody says, oh, see, we got you out. We eliminated or avoided this big pullback. Well, you still lost because you got out back here. you still miss this gain right there. That was a huge run. And then it just turned off and continued higher. So you can see that just because you get into something that might be a statistically significant high or low doesn't necessarily mean that it's about to turn. So let's try a couple more. There's one. There's some in the middle. Let's see if we can find one at a high or low. Here's another good example. So maybe on this date, everybody's screaming, hey, we're at all-time highs. Look at all the data. We're at all-time highs. And they assume that means we're about to turn. See, that's the fallacy. And so again, the main point that I want you to get from this, it's super easy to say that we're at all-time highs. That's just a fact. That's not a prediction. But that doesn't mean that we're about to turn. And in this case, if you got out back here, look at what you missed. Even if the market does correct back up into here, you didn't avoid anything, you still missed out. See, that's the second part of the problem, is that if you decide to completely get out, you'd better hope that that correction happens quickly. Otherwise, you could be missing out on the biggest gains that you've ever seen. So what's a better idea? Well, don't predict when markets will turn. We've all seen that it's incredibly hard to do. You're not going to make money by making predictions on when the markets will turn. Highs can go higher, remember, a lot higher, and for a lot longer. So the better idea, the thing that you really should be trying to learn and trying to understand, is how to hedge your positions. How can you stay in the position longer? How can you hedge, roll, morph, so we can continually sweep money into our account, lock in some gains, but still keep some positions open if that market continues higher. But if it doesn't, we can at least have some hedges on to minimize the damage. And that is going to make you a much more successful investor. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.